All right, everyone. Well, welcome in today's investment town hall. We're glad you can be with us today. I'm Abe Abish,
I'm Pat Volk.
and we are the investment advisors here at Abish Financial. And typically we have these investment town halls quarterly, just to give our clients, our existing clients, an update on the market, but also our prospective clients as well. Not only an update on the market, but an inside look as to how we manage here at Abish Financial, and how we weather the ups and downs, and how we put a retirement plan and a portfolio together for a pre-retiree and a retiree. Okay, so a couple things we want to address today, and this presentation should be maybe 15 minutes, and then we'll open it up for a few questions and answers at the very end that we'll answer live today. So we want to address the current state of the market. It's been quite a roller coaster here the last couple of weeks, up a couple percent, down a few percent, just jigsaw back and forth for the last few weeks. Are we overvalued? We definitely believe very much so. We're going to talk about U.S. Treasuries and what the 10-year Treasury yield has done here in the last 2 weeks. We're going to talk about China, also energy and greenflation. And first we'll start with, are the markets overvalued? Yes, we believe very much so. And one of many indicators we kind of look at is the Shiller PE ratio. PE stands for price to earnings. And when we look at the ratio of what someone is willing to pay for a stock, normally it's about 13 to 15 times per dollar. So you would imagine you would typically pay 13 to 15 times for every dollar worth of stock. Well, going back to the late 1800s, you can kind of see where the PE ratios were, in the kind of normal range back in the late 1800s, crossing over the 20s in the early 1900s. Black Tuesday, Great Depression era, the price to earnings ratio went a little bit above 30, all the way up to the tech bubble. And the price to earnings ratio at the peak of the tech bubble was 42. I know you can't see that number, but it was 42. And today we're at just below at 38 for the PE ratio, when a normal price to earnings ratio is 13 to 15. So we're not saying the market's going to fall off, but we do want to look at indicators. And Robert Shiller is a Nobel Prize winning economist that came up with this ratio. So just one of many indicators and charts that we're looking at, and kind of just making sure our clients know that, hey, markets are overvalued. We want to be prepared if the markets do fall off. And our current clients are prepared. Our prospective clients, you'll learn more about today, how we put portfolios together to prepare for big time losses.
Yeah. One thing that I'd want to reiterate, when we talk about whether markets are overvalued, is we're not trying to put a pin in this and say, going forward, we think it's all down. Not at all. There are a lot of factors occurring. And for those of you who read the recent newsletter, I'm going to allude to a number of the factors. Some of these factors are going to be negative. I hate to say that negative news does tend to lead. It's easy to talk about, but there are some positive features out there. Overall though, we need to keep this in light that we have been running in a virtual bull market since 2009. And there's a multitude of reasons for that. Some of them good, some of them a little concerning. So we do want to address a number of the issues, with relation to that. First one that I'd want to really hit upon is inflation. We brought this up in the last meeting, our town hall that we had. It is a very common topic. People are concerned with how far is their dollar going to go. I'm old enough to remember back into the 1970s when my dad used to make the joke that it used to be that I could walk in, with a small amount of money and a basket full of groceries. Now I walk in with a basket full of money and I walk out with a loaf of bread. That in essence really kind of summarizes the damage that inflation can have. Problem is, with the Federal Reserve dumping so much liquidity into the market on a month-by-month basis, we're going to have more and more dollars chasing fewer and fewer goods. Couple that with a pandemic where we've shut down, where we have supply chain issues. Those of you who may have seen the map, we have container ships sitting off the coast on the east, on the west coast, that are just waiting to come in. This is a supply chain issue, which is causing not only the shipping industry to escalate in price and have a tremendous amount of inflation, but just also the regular prices of goods and services. Walk into the grocery store and you've probably realized that things are getting a little bit more expensive. Where I think this is crucially important, when inflation first became the topic of conversation was probably mid-April of this year. Fed came out and basically really kind of quelled that. They said it's transitory. We feel that this is just the results of coming out of the pandemic. Unfortunately, now no one's really buying that story. It's not believed anymore. And you saw that with the sell-off in the 10-year Treasury. What's really happened over the last few weeks is that you've seen yields on the Treasury spike from 1.3 to 1.5. Meaning people are selling out of those treasuries. Now, let's not forget, the Federal Reserve is injecting money into the economy by the purchase of treasuries. They inject about 120 billion, 80 billion of which is US treasuries. So you still had a massive sell-off occurring amidst all of these purchases, meaning nobody wants to hang on to a 10-year note that's yielding 1.3 in an inflationary environment. They're just going to lose money on that. The government, Federal Reserve, frankly, doesn't care. They're not in it, to make yield. They're not in it to kind of keep ahead of inflation. They just want to buy off the particular bond. So that was probably one of the major issues that have occurred over the last couple of weeks that has caused a little bit of tumult into the markets. I want to address a few other points. The 10-year Treasury rate, just looking at here, you can see where we had, much higher yields not that many years ago, the real big drawdown during the pandemic, the spike, as I had mentioned, somewhere around April of this year, gradually coming down, and then you can see in turn where we are right now. Again, I don't feel like this is a definitive marker, but it definitely did ruffle the market, especially a lot of the overvalued areas of the market, tech in particular. One other concern that I've noticed in the markets, and I bring this up often, and because it's really a topic I don't see too many folks speaking about, pops up on the news channels every so often, is what's called the reverse repo market. First, what is the repo market? The repo market is the ability to the Federal Reserve to quickly inject cash into a system outside of quantitative easing, where they can basically take treasuries from a bank and in turn return them cash, adding a little bit of liquidity. You'll see this happen every so often when taxes come due, things of that nature, temporary liquidity needs. The reverse repo market, frankly, is the exact opposite. It is where the Federal Reserve is taking excess cash away from the banks and in turn returning US treasuries to them. They're not selling, it's just an exchange. So nothing's being demolished, nothing's being sold. Where the concern is, when I started bringing this up, we were somewhere around $800 billion in reverse repo, a number that had never been seen before. We have virtually doubled that in such a very short period of time. Meaning, if the Fed is injecting $120 billion of liquidity into the market, via the banks, it's not directly, but it does eventually get around to the banks. Why are they sitting on 1.6 trillion, 1.4 trillion in cash? They're not utilizing it. They are saving it for some reason, whether that is to go into the market at a value price, whether that is simply because they want to make sure they're securing things. It does tend to be a bit of an ominous, an ominous figure, very frankly. I'm a little concerned about it because I don't see where the market is really functioning properly if the banks are hanging on to so much cash at this point. Another issue that I had brought up in a previous newsletter, Evergrand, a very large property developer over in China. This story is not near its end. It is far closer to its beginning. Basically, what has occurred here is China has clamped down on over-leveraged firms. predominantly property developers who gather up assets, who borrow a lot of money so they can in turn start building projects, start building buildings, and eventually sell them to then in turn pay off the debt. China clamped down on that about a year ago, causing a lot of these major property developers to really get extraordinarily tight. They weren't able to sell the properties as quickly or build them as quickly enough to pay off the loans fast enough. And Evergrand kind of came up as the issue back on September 23rd when it looked like they were not going to be able to make an interest payment on a particular bond. That raised a concern. Oftentimes people were talking about, oh, it's not really defaulted yet, because it technically hasn't. Much the same way if you miss a payment on a credit card or any bill that you may have, you generally have a grace period. So we're not going to find out how severe the Evergrand issue is really until the end of October, October 23rd or so. Chinese government is not the US government. It is a communist regime. They have far more control over everything. They have asked the banks to really give Evergrand a little bit more time. But what they have also said is China first. They are not going to allow a default on a lot of Chinese issued bonds, but dollar denominated bonds they don't really care about. One other major issue. The real estate market in China is far larger than it is here in the United States. It makes up close to 12 to 15% of its gross domestic product. That is a massive hit that we could be seeing here. I mentioned contagion. Why? Where are they getting the metals from? Where are they getting the workers from? Where are they getting all of these supplies to build these properties? A lot of it's from Australia. A lot of the money that is being lent is also coming from UBS, HSBC, big banks here in the United States. How large of this mess is out there, we really don't know. But I wanted to at least acknowledge there has been a bit of a contagion already. There is another very similar company to Evergrand known as Fantasia, which has missed a debt payment. So it is permeating throughout a lot of the property developers and a lot of the real estate market in China, which is going to cause a bit of a long-term problem. That is a pressing issue. Don't want to go off too much on the political realm, but also China doing a little bit of saber rattling with respect to Taiwan. You really do have to wonder what an economy that is looking to become number one is really going to do if they feel threatened and feel like they're going to run into, very frankly, a situation that Japan encountered in the late 80s, early 90s, where everybody remembered Japan was taking over the world. And where are they now? Their economy faltered. They have really not been pressed. But Japan is not nearly, as sharp as China is at this point. Japan is rather toothless. China may be willing to do something very comparable to Taiwan as what they had done recently to Hong Kong. That could be a far major concern on the negative side. Some other issues that are out there, and it's not just affecting Europe, it is also affecting China, it is affecting India, and it is affecting a lot of up and coming economies, is the energy inflation. Eurozone inflation really has hit its highest levels. This is really what I'm going to refer to as greenflation. It's not as if we don't have energy available. Coal is readily available, oil is readily available, shale is readily available. They do not want to use these particular forms of energy, primarily due to climate change. They want to get rid of the old energy, dirty energy. They want to move over to clean energy, be it wind, be it water, be it whatever they're looking at. This is really where we're running into a lot of problems. Supply lanes have been demolished. You are not able to get coal shipments, natural gas shipments. All of these shipments have been really paused to a great degree. They just don't start up. If you don't throw a train off the tracks and then expect it to start up immediately the next day, they have to get the pieces in place. So that is a bit of a man-made problem, as well as a lot of these countries are walking away from what they refer to as bad energies. Germany just shut down one of its major functioning nuclear power plants, causing problems. The green energy is not efficient yet. It is not capable of filling in the space of the old energy, causing the surge in price. Countries are still utilizing some of this. India, China, Bangladesh, that's where these folks are really building their economies around, are these old forms of energy. and their economies could truly get crushed in this particular environment. This is a man-made problem at this particular point. There are some political players out there, Putin as an example, cutting the natural gas, moving over from Russia into Germany tremendously. I think it was about a 57% cut, basically just to play a bit of a game, and also in protest of the new pipeline running through the Ukraine. So we are seeing a lot of problems in this particular area. It could spread a little bit further. We here in the United States have plentiful natural gas. One thing that's really unusual, though, is that we don't package it and ship it out for sale. We tend to keep it within the United States. But it is possible that we could have some energy inflation, much like we've been seeing in oil, over the next few weeks or even months. Again, something that's a bit of a concern long-term for the economy. Want to just, before we continue on, to say, what are some of the positives that we see out there? Frankly, it could be a short-term positive. Getting the debt ceiling raised, good sign. If they are able to pass a stimulus package, that could be a tremendously good sign. I don't care if it's $3.5 trillion. I don't care if it's $1.5 trillion. From the market's point of view, having that amount of money come into the marketplace could truly be a positive. The Federal Reserve has rumored again that it may taper the quantitative easing. Doesn't mean they're just going to pull it completely from 120 billion down to zero. They'd probably be pulling it down from 120 billion down to 110, 100, down to a floor of eventually $30 billion sometime mid-2002. But that could also be the other positive. The banks are sitting on 1.6, 1.4 trillion of cash. There may be a very good reason for their doing that, enabling the Fed to be able to back off and not feel as much pain. So it does put us in a bit of a pickle. And you've really seen this surging around this particular week. It's on one hand, we do have a lot of bad news. People think the markets are overvalued, energy prices, the political climate, etc. Here to pull the market down. We wait a few days, suddenly, oh, looks like the debt ceiling's raising, looks like there may be some political positives out there. We're going to continue to kick the can down the road, and the market tends to, perk up. It's very difficult in an environment such as this to say, this is exactly the course that we're going to take. So this is where we do need to lean back and say, long-term strategies. We're not trying to catch a falling knife here. You cannot call the market in any given day. If I tried to do that, I'd be more wrong than I am right. If I knew how to do it, I'd be in Tahiti. I say that all the time, but truly mean that. So this is when we need to really lean back and focus in on what are our long-term plans? What are our long-term strategies? And kind of turn it over to Abe to talk about some of these as well.
Yeah, sure. So we're, as most of you know, and for those of you that are not clients, you may not know, we're a retirement planning firm, a fiduciary retirement planning firm that primarily only works with people 55 years old and older that are typically 5 years or less away from full retirement. A lot of people are coming to us this year saying, hey, we're retiring by the end of 2021, we're retiring in 2022, but most people are retiring pretty soon. And our forte as a firm really is helping people transition from their working careers into retirement, and not only just crossing over the finish line successfully, but through retirement. So you have a financial and retirement plan that lasts you through your 80s and 90s, as long as you live, that helps address all of the problem areas that can mess up a great savings and accumulation and investment plan. So there are only two phases of a retirement plan, phase one and phase two, growth and income. There's no in between. And most firms out there stop at growth. In other words, they may just typically focus on investment management and rate of return and what you're earning. Well, most people that we meet with and most of our clients have saved enough. The issues and potential problems are really in phase two, in the income phase, as our wages have stopped and we're relying on everything we worked so hard for the last 30 or 40 years to last us the next 30 to 40 years. So what are those concerns? A lot of what we talked about today already. Inflation. We haven't talked about taxes, but there's a lot of tax changes that are probably coming down the pipeline here. So inflation is a major concern. Taxes. What if we have a healthcare event? Are we protected? What about sequence risk? The risk to you in retirement that when you're receiving income from your portfolio and withdrawing, distributing for the first time in your life, that the markets are also down. at the same time. So that's why people hire us, is to really help them protect their nest eggs and protect them as much as possible from all the things that can mess up a great savings plan. Bond market alternatives. Well, frankly, interest rates are very low, and you're lucky if you're picking up 1% on cash. You're fortunate if you're picking up 1.5, maybe 2 at best on treasuries. You're really fortunate if you're picking up 3% or more on a bond, which is almost unheard of nowadays. And most bond returns we're seeing right now are in between 1.5 and 2.2, 2.3. Well, a traditional financial planning approach to a retirement plan would say, all right, you're 65 years old now, put 60% in equities, 40% in bonds, because you don't want all your eggs in one basket. So have 40 to 50% of your portfolio protected in cash, treasuries, and bonds. Well, in the past, we could pick up 5 or 6% yield on bonds. And if we could pick up 5 or 6% yield and interest on our safe monies, and then earn maybe 7 to 10 on our equities, wow, that was great. Today, we can't do that. And on cash, treasuries, and bonds, we're fortunate to earn 2, if that. But then we don't feel it's fair and right to go and then charge a fee to our clients to manage their portfolio and stick 40% of their monies in asset classes that are earning 2% or less, and us charge a fee on top of it. So what do we do as a fiduciary firm? We look both in the market and out of the market. And one of several out of market strategies and alternatives we're using as the bond placeholder and bond substitute is the fixed indexed annuity. There are a lot of annuities out there, a lot of crappy ones, a lot of good ones as well. We work with many companies on the insurance side, and we know that space very well. And what we do is we find a no fee fixed index annuity that's going to give our clients the highest upside possible without a fee. What is that upside looking like? 4% to 6%. That's kind of the range based on the last 26 years and the range that we're telling our clients to expect. Well, 4 to 6 is a lot better than 0 to 2 or 0 to 3, while keeping our money safe, while protecting a portion of our principal as we make this transition from our working career into retirement. That's going to provide our clients some safety. Your eggs won't be all in one basket. If the markets take a dive, usually we're not going down as much as the major indexes or as another advisory firm out there, or maybe as on your own. So a portion of the portfolio's insulated, protected. The other portion, we're going to have some ups and downs. We may not get all the ups, but we typically don't get all the downs either. Typically makes for a good yield, good return, while minimizing and lowering the risk. We're looking for the highest returns possible with the lowest level of risk. So that kind of summarizes kind of how we pair and marry both in-market strategies and out-of-market strategies.
And I wanted to speak a little bit to some of our, managed market-based portfolios and, what's really been going on with some of the asset allocation. Some of you may have noticed some of the trades of recent. The artificial intelligence that we've been utilizing has typically been extraordinarily conservative. And last week, it did start making more positive calls. Again, it makes the call every 5 days. We're not through this particular week yet, but we were, at least on part of the portfolio, very honestly disappointed with it's such an aggressive call into the tech sector. There's no way of not being able to own that. It was for 1 week. I do feel the problem that we went through and that we have been discussing with the actual managers are they tended to be so conservative. So it wasn't as if there was a lot of reward on the upside, and then they did suddenly go very positive, and it seemed like they stepped right in it, unfortunately. We have reallocated the majority of the portfolios into a number of different strategies that have some risk off, risk on philosophies behind them. So you may notice a little bit more of higher cash positions in the portfolio. Just kind of maybe bounce off of what Abe just said. We're not looking at those for long-term solutions. We're not looking to say that's going to be the portfolio long-term. That may be the portfolio for the next week, the next 2 weeks, until we really can get a better handle on where some of these trends are going. We're trying to play it very carefully right now. So we are aware of, what the portfolios have been doing. We are ahead of it. We are making changes as things are going on. And we are talking to all of the portfolio managers as it is. We still believe that a risk on, risk off philosophy in the long run is very good. As I use the analogy all the time, we're trying to pick the highest probability of outcome every single week. That doesn't mean if I'm watching a poker game and I'm saying that guy with the best hand, he has the highest probability of winning. That may be mathematically true. That does not mean in reality that that is necessarily going to come true. There are some factors that are completely out of the analysis control. So we are aware of that. We have been monitoring it. We will be more than happy to speak with anybody if they have questions, concerns about their portfolio in particular. Overall, our goal is to deliver a very reasonable rate of return with a lower deviation for the entire portfolio. We do need to always address that. The market-based portfolios are just that. They are market-based portfolios. When we sat with our clients, in fact, all of you who are our clients, we always ask about the risk tolerance, what scale do you fit on, and we always invariably bring up the fixed indexed annuity as the bond alternative. We are looking at your portfolio in total, not just the market-based, in total. We know we have a safe section and we've taken on risk based upon your personal situation on the market base. So we do need to look at the entire portfolio. But again, with that in mind, been aware of the ups and downs in the market, more than happy to speak with anybody with any questions or concerns. So again, we still are fully believing in our philosophy, and we do think that going forward, there are still some positive signs out there, regardless of some of the negatives that might be out there as well. It's going to be very difficult to make a call.
All right, go ahead and open it up for any questions. And if we run out of time today, we'll have a few minutes to open it up for questions. If we run out of time today, just call our office or email the info@Average Financial box and we'll get right back to you. Let's see here. No questions so far. Just give it a minute or two. Just give it one more minute, see if anyone has any questions here during the live webinar. All right. Well, no questions at this point. So if you have any after watching this today, a recording will also be made available and be sent out to our database as well. So you'll have the opportunity to watch it again. But if you have any questions, whether you're a client or prospective client of ours, if you're a client and if you have any questions about any of your strategies, your portfolio, your plan, just give us a call and we'll get back to you and set up a time to discuss. If you're a prospective client of ours and you're not yet a client of Average Financials, we'd love to give you a complimentary second opinion on what you've done for your retirement, kind of give you a compass check as to what your plan looks like today versus how we put together a retirement plan. You might find it pretty refreshing to take a look at the differences there. So we're happy to provide that to you complimentary at no charge. Thank you for attending today, and we hope this was helpful.
All right, thank you very much. Hope you have a nice night.